Hello and welcome everybody. I'm Stephen and I'm a popular investor on eToro. Thanks very much for listening to this video today, and don't forget to like this video and subscribe to my channel. That will be really appreciated. So I'm going to be doing a new video format for you all, and that is because I wanted to make it more interactive and I wanted to make the experience more visual. Previously, before, it was me providing some really good information to you, but it was quite hard to take in without any visual cues. So I will be making it more visual. So in today's presentation, I'm going to be talking a bit about what happened in the markets last week. And I'm also going to be talking about some of the key positions that I took, as well as talking about any changes in strategy. So let's get started. So if we look at the performance for last week, the performance for last week was quite good if we compare that to the benchmarks, although it was down. So it was down about 2.2% overall for the week. If we compare that to the NASDAQ, which was down about 4.8%, and the S&P 500, which was down about 5.9%, and Bitcoin, which was down a whopping 8% last week, I think that we did okay considering what happened in the markets. So last week, the US and European markets suffered quite significantly, as well as crypto. However, it was a much better week overall for China, and we do have quite a few Chinese stocks in our portfolio. We also did quite a lot of short-term trades last week. So as I've been mentioning previously, that I had been taking profit on my Chevron oil positions. And about 2 weeks ago now, I took the final bit of profit on my Chevron position, and I actually rotated to 𝘁CO, which is a inverse leveraged ETF, which obviously profits when oil price goes down. Oil prices and commodity prices went down quite significantly last week. And I managed to book in about a 10% profit on that 𝘁CO ETF. I also did about 3 different trades last week in ASOS, which is an online clothing retailer. And that is because they had some weak earnings recently, and also they had a change in the CEO. And they also warned of lower revenue and profitability figures over the next couple of months. So I thought it was a good opportunity while it sold off quite heavily, and I conducted 3 successful trades. I also did other trades last week, both long and short, in Cal, in 𝘃𝗶𝗱𝗲𝗄, Wizz Air, Freshness, and even a natural gas trade. And previously, before, I had been shorting indexes in order to kind of hedge my portfolio and to reduce the volatility. But I found over the last couple of months, I feel like it's much better to do these kind of short-term trades with only a small portion of our portfolio. And that allows me to be able to book in lots of small profits, and allows me to be able to go both long and short, which helps our portfolio be more dynamic. If we compare how our portfolio is done for 2022 year to date, it hasn't been a very good 2022 so far after a really great 2020 and 2021. So thank you all for your patience. Our portfolio has been down about 35% overall for year to date. And if we compare that to the NASDAQ, which is down about 27.5, and the S&P, which is down about 22.9, and Bitcoin, which is down about 55.38, you will see that we're kind of sitting in the middle of all of those different benchmarks. And that is because we have quite a high proportion of crypto in our portfolio. And that has dragged down the performance of our portfolio if we compare it to the NASDAQ or the S&P 500. But obviously it has a lot more upside potential than those indices as well. So there could be a little bit of volatility in the short term. However, I do expect that situation to improve over time, and I thank you all for your patience. As I move on to the main news of last week, the main news was the Fed raised interest rates by 75 basis points last week, and this was the highest increase in one meeting since 1982. And it's been quite clear over the last kind of 6 to 9 months that inflation is starting to run out of control. And about 2 weeks ago, the CPI figure came in very high at about 8.6%. And it really showed that the Fed need to do more in order to be able to control and reduce inflation. So they felt it was necessary to increase by 75 basis points. I think that they will continue over the next couple of meetings to increase their interest rates. It might not be by 75 basis points. It could be more likely about 50 basis points. However, I think that they will continue to increase those interest rates until inflation has peaked and starts to reduce slightly. Although I think it's very unlikely that it will hit the inflation target that the Fed has in place of 2%. Unemployment is still very low in the economy, but it's increasing as inflation and profitability takes a hit. As we kind of step into more of a recessionary environment, it causes people to spend less and profitability to go down for companies. So it will increase quite naturally the unemployment rate over time. However, historically, the unemployment level is still very low. We also saw oil and gas take a big plunge last week. As I said, I thought that commodity costs had got a bit above themselves, especially oil and natural gas. And although I do expect oil to be higher for longer, I do think that kind of a more natural level is between kind of 90 to kind of 110 levels. And I saw a good opportunity to place a short on oil last week. The housing market also is starting to see the impact of rising mortgage rates. And that is because less people are buying new houses at the moment because those mortgage rates have increased as the interest rates have increased as well. So we're starting to see early signs of that affecting the housing market in the US. We also saw some recessionary triggers as well in terms of the retail sales, and they dipped by about 0.3% in May. Obviously, one of the first things that happens as inflation increases and the cost of living increases and eventually unemployment starts to go up, what happens is this puts pressure on households to spend less money, and then you see a lower retail sales figures as time goes on. We also saw some major news from Europe, where 2 central banks raised their interest rates last week. So the Swiss National Bank raised their interest rates by 0.5 point to minus 0.25%. And the Bank of England, who has continued to increase the rates over this year, has also done another interest rate by 25 basis points, and that takes it up to 1.25%. But I expect them to also continue to increase those interest rates over time in the UK. We also have seen, on the flip side, we have seen some improvements in the Chinese economy, and Chinese stocks did quite well last week, which helped our portfolio. Manufacturing activity was up. And a lot of the reason why it was up is because some of these COVID restrictions in China have been reduced. And this has allowed people to go back to work in the factories and the manufacturing activity to increase. We're also seeing some positive signs that with retail and property sales were higher than their expectations by analysts. So some positive signs from China that we could have already bottomed in Chinese stocks and that we are starting to see a recovery. And as I've said, I do expect a very strong second half of 2022 for Chinese stocks. A little bit more about the macroeconomic situation. As I said, higher commodity prices, I expect them to stay higher for longer. And that is because of a lot of the supply constraints, because of the Ukraine-Russia war. Obviously, Russia is a big supplier of oil and gas to Europe and the US to a lesser degree. And by the war doesn't seem to be letting up anytime soon. So I think it's very important that they need to find new countries and new ways of being able to get more oil in. And however, this is going to take time because the supply chain can take quite a long time to come to fruition. Also, OPEC are slightly increasing those production rates, however, not as fast as a lot of the governments would like them to, but I do expect them to, countries such as Saudi Arabia and other big oil producers, to increase their production over time. And then I think what we're likely to see is more kind of a higher for longer oil price, but probably in the 90 to 110 type of range. As I mentioned, interest rates are rising throughout the world. Expect that to continue over the next couple of months. However, at some point, I do expect something to break where they can't increase the interest rates anymore without really negatively affecting the economy. And then I think that they will either slow those down, halt them, or start to do easing again, but that's going to take a little bit of time for inflation to come down. Or they could just halt or slow those down once inflation hits a peak. However, if they do that, then it's quite likely that we're going to see, again, higher inflation figures and spikes up and down in inflation for longer. And I wanted to pose a question: is an economic soft landing possible? And I think the short answer to that is not really. What I kind of compare it to is I compare it to a kind of a helicopter trying to land on a moving runway. It's very difficult to do. So the Fed has two dual mandates. One is to keep the markets running efficiently and smoothly. And the second is to make sure that inflation doesn't get out of control. Quite clear that inflation is much higher than they want it to be and they expect it to be, and it's having a negative effect on the economy. But this is the first time, one of the first times in history where we are actually increasing interest rates into a potential recession. So this is very difficult to do, and it's going to be very difficult to judge. And essentially, I think that the Fed are going to be forced into choosing between much higher inflation or a deeper recession. And it's hard to know which one they will choose. I think a lot depends on the severity of inflation in the future. Yeah, they're going to have to choose between the two of them, but I don't think a soft landing has much precedence. So supply chains, obviously the supply chains are quite broken at the moment. We saw a lot of delays in terms of semiconductor chips for auto manufacturers. And we also seen a lot of food shortages and fears of food shortages around the world. And it's quite important that those supply chains, start to perform better, or we start to look at more kind of local supplies. Unemployment is low, but is rising. And it's important, if you look at kind of 2008, 2009, and then you look at kind of 2020, but that was slightly different because of the COVID-19 urgency, then you can see that unemployment, although it's at historically low, it can speed up very quickly if there is recessionary times. Strength of company earnings, we've seen pretty good strength of company earnings over the last couple of months. And I think it's quite likely that we might not see the same amount of growth that we had over the previous decade. So there may be slowing growth, but I still think there will be quite strong growth for many of the major companies. So this is a section I have named Death by Charts, in which I'm going to be running through 4 different charts each week in my presentation. And the first one on the left is the US Consumer Price Index. And that is overlaid with the federal funds rate. And as you can see, the CPI figure was at about 8.54. However, the federal funds rate is still very low historically. And if we look at that in kind of 2019, they tried to increase the interest rates then, and the Fed had to pivot and start to ease again after that period. And then we sat at very historic low interest rates, basically at 0 for quite a long time. They're trying to ramp that up, but as you can see, we are still quite low in terms of the interest rate. So they probably have quite a lot to do before they can really tackle inflation in any meaningful way. Earnings growth has remained positive, but I expect it to slow in the quarters ahead. I say slow, I don't think it's going to pull back significantly, but I think that there could be some slowing of growth as consumers start to feel an effect on the wallet. And then the jobless claims are starting to rise. And we've seen that from, if we look at that on a trough to peak basis on a 4-week average, you can see that although very low, it started to increase slightly. And then future returns are strong when sentiment is low. So I just wanted to say here that it's a really great opportunity quite often to be averaging into stocks when the market is fearful and the sentiment is very low in the market. If we look at the chart in the bottom right-hand corner, we can see that the S&P 500 average over a 12-month return when the consumer sentiment index is below 75, then the average return over the coming 12 months is about 12.4%. And that makes a lot of sense because stocks are much better valued now than they were, say, at the end of 2021, early 2022. So there is a very strong upside if we start to see a little bit more strength in the economy. So if we look at the crypto news now, and I'm going to be giving you my news and my views on the market. And Bitcoin has fallen by 70% from its all-time highs, which were claimed in November, which were about 68,000. Bitcoin dropped to under 20,000 this week, to 18,000. and now it's just creeping up over 20,000, and it's the first time that it's gone below the previous cycle all-time high on the low side in the bear market. And I think that's been caused by a number of different reasons. One is I think we're in a risk-off environment in the global macro. I think crypto is being put in with growth stocks and other tech stocks. And I think a lot of large-scale asset managers and funds are trying to reduce the risk and the volatility in their portfolio, which has led to some sell-offs. I think there was also some black swan events. We saw Luna and the UST debacle a few weeks ago, which caused a lot of fear and caused a lot of people to sell off their Bitcoin, and the Terra Foundation also sold off a lot of Bitcoin. And then we have seen Celsius, who have stopped withdrawals for the lending platform. So again, this is causing a lot of fears in the market about a potential default. And Three Arrow Capitals, which is a very large VC in the crypto sector, is suffering very much so, and is facing extinction as well. And this has all weighed very heavily on the markets. And this has caused an increase in liquidations and an increase in volatility. And what happens during these kind of black swan events is you see in crypto, there is a lot of leverage in the system. So traders are doing a lot of leverage trades. And when you have these kind of large black swan events, then it causes the highest leverage people to be liquidated first. And then this then kind of seeps down towards those with low leverage. And it causes them to be stopped out and then them having to sell the Bitcoin. And although this is incredibly sad for a lot of people losing money in the short term in the industry, often it is needed in order to kind of find a bottom area. And then you see a lot of the long-term hodlers or the crypto natives buying up that Bitcoin, and then it kind of forms that bottom. Another thing we're seeing is miners selling off the Bitcoin. So what happens usually during a Bitcoin cycle is when the price is going up of Bitcoin, then miners are making more money, they're making more profits. It's quite easy for them to get more capital, cheap capital, in order to be able to keep their operations running. So they basically hold on to that Bitcoin. And when price starts to go down and they start to be less profitable, when they start to run into financial difficulties, then they're forced to sell off their Bitcoin. And this happened in 2018 as well, towards the bottom, where the miners were one of the last subsets to really capitulate. And this kind of formed a bottom of the Bitcoin miners. Formed a bottom of the Bitcoin market once miners had sold off a lot of their Bitcoin. And I expect a lot of consolidations in Bitcoin mining companies to happen over the next few months. On-chain metrics are still pretty good in terms of Bitcoin. We're seeing hash rates is doing very well. It's increasing, which is good for the security of the network. Lightning network capacity is at an all-time high. It's continuing to expand. However, the number of transactions on the Bitcoin network is reducing, but I think this is pretty normal during a bear market, because there's obviously a lot of speculation and trading in the market, and this reduces the number of transactions as there are less participants taking part. So I mentioned many ways in which the Bitcoin can find a bottom. I don't know if we have hit the exact bottom yet, but I'm very confident that we are at least very close. And lastly, you will see a lot of the bears doing laps of honors at the moment. You'll see Peter Schiff on Twitter. You're also seeing a lot of naysayers are saying, doing those laps of honor, saying, I told you so. and you shouldn't have invested in crypto. And historically, they have been wrong throughout the years. Yes, you do have these bull and these bear markets, which can go very high to the upside and very low to the downside. However, if you look at Bitcoin over a much longer period, over 3 or 4 years, for example, it's, you know, it's likely that you're going to be a lot more profitable in the long run by holding on to your positions. However, it is a new asset class and there are always risks attached, and there is no such thing as a sure thing. So please bear in mind when you make your investments that in crypto there is a higher risk but a higher reward potential. So I wanted to do one last slide which says history doesn't repeat but can rhyme. And what I was mentioning there about the kind of 4-year Bitcoin cycle and those bull and bear markets, if we look at the last bear market on the chart to the left, in 2008, from the very top of the market at the end of 2017 to the end of the bear market, the very bottom of the bear market in 2018, that was at about 363 days from the top to the bottom. We're currently sitting at about 221. That chart is a little bit outdated. However, and Bitcoin is about 70% decline from its all-time high. So again, I don't think we are that far off forming a bottom. And what I expect is each cycle for the highs to be lower in percentage terms than they were in the previous cycle. And I expect the lows to be lower than the lows from the previous cycle as well. So I think it's the diminishing returns theory. And I think that this naturally happens as an asset continues to mature. The other chart, which I thought was very interesting, which is very different, but sends a very similar message, is that the Bitcoin's cyclical bottom was 780 days to 880 days after each of the previous halvings. So just to let you know, the last halving was on the 11th of May 2020, which was about 770 odd days ago. So if we look kind of on an average of the previous halvings, we are very close in the amount of days after a halving to the bottom of previous cycles, which could also show that we are getting close to another bottom, especially if we take into consideration that, you know, in 2 years, there's going to be another halving, which reduces the number of new Bitcoin coming into the market in half. I think we're in a good place to have some strong returns in the future. So thank you very much for listening to my video today. I hope you really enjoyed the new format. Please do let me know or not whether you prefer this format or not. And also don't forget to join my Discord group. We have a really awesome community of people who are regularly talking about the markets. I will leave the invitation below to my Discord group. Thank you and have a great week ahead.